The first and most important trend in markets right now that investors need to know about is the end of the bull market in bonds. We've had falling interest rates effectively for 35 years, and that means there are almost no investors who understand what rising interest rates mean. Rising interest rates mean a couple of things. Number one, it means it's very hard to make money owning government bonds or corporate bonds. Number two, it means valuations of equities and other assets usually come down. And number three, it means that asset allocation has to shift. You now bear more risk and less protection owning government bonds and interest rate bearing securities than you used to. So I think when investors are constructing their portfolio, they need to understand that there's a changing role for duration-based assets or interest rate-based assets. That's important because the way you do your asset allocation obviously grossly affects your total returns. GARS stands for Global Absolute Return Strategies, and what we try to do is produce a portfolio that has the opportunity to make money regardless of what kind of investment or economic environment we find ourselves in. So one thing is certain: we don't really know what the future holds. We can make lots of forecasts and do lots of analysis, but in the end, economic growth will be slower or faster than we expect. Earnings growth will be slower or faster than we expect. Inflation will be higher or lower than we think we first analyze. So what we have to do is try to find a myriad of strategies that are very different in their nature. Rather than simply saying, I will buy several different asset classes, here we're trying to say, I'm going to try to buy several different sources of return. And by analyzing those sources of return very carefully, understanding the risks of each of those investments, and then constructing the portfolio so that we can make money in most, if not all, investment environments, we come up with a very different characteristic for the GARS portfolio than what you'd expect to get from any single asset class. In numbers, we're trying to get a 5% return over cash with only about a third of the riskiness that you'd have to experience in equities or bonds or any other single asset class. That combination of a higher return but a lower total risk serves a lot of our clients, both institutional and individual. Well, Korean equities represent a very interesting combination of emerging markets and developed markets. Let's remember that the Southern Korean economy and market is one of the most export-oriented and Western-looking markets of all of the emerging markets and certainly of the Asian markets. They compete directly with the Japanese market for exports, and they compete directly with the rest of Asian emerging markets for manufacturing capacity. If global trade is good, Korean equities tend to do very well. We can't ignore the risks though. Remember that just north of the border, we've had a very acrimonious relationship between North and South Korea. So understanding those risks and being able to bear that single risk along with the opportunities that these very valuable and usually very inexpensive Korean companies have is the reason that we've added Korea to the portfolio. But I'd like to be specific. If the only equity investment an investor could make was Korean equities, I would not advise it. It's because of the breadth of all of the other investments in our portfolio that we can afford to take the risk of owning Korean equities. In combination with everything else we have, we produce an overall portfolio that has high return potential and lower risk characteristics.